Welcome, everyone. I'm Felix. I'm part of the investment team at Seedcamp, and I'm very lucky to be joined today by one of our managing partners, who I'm sure you all know, Carlos, for what is actually the first episode of a mini series that we're doing on all things cap tables.
So thanks love cap tables, Felix. I love them.
Thanks for joining me. I'm excited. So to give some kind of brief context as to why it is that we're putting these episodes together and why it is that we're diving specifically into cap tables. So as a kind of pre-seed and seed stage focused venture fund, we are lucky to meet hundreds of founders a year and invest in a subset of them. And for many of them, it's the first time that they are raising kind of capital for their startups, and it's the first time that they're starting a company. And unfortunately, something that we often see is kind of cap table related mistakes being made by founders at the very early stages of their journeys. And these can have kind of serious consequences down the line, especially when it comes to raising kind of follow-on funding, at the Series A, Series B stages, etc.
Yeah, so Felix, let me tell you, like the number of headaches that I have seen that have come out from poor cap tables. Actually, I have a founder at the moment who's going through and trying to piece together what the cap table should look like from a lot of outstanding convertible notes. So like there's a real danger if you accrue too much cap table debt and you have no idea where you are, because then it prevents you from knowing how much you can raise, what the impact of dilution is on your existing shareholder base, how much you set aside for employees. It's super important, and it's a headache for a lot of people that don't invest early in understanding what's going on.
Yeah, and Carlos, I'm going to ask you to hold that thought to also dive into a little bit further, I guess, explanation as to some of the issues that you've seen arise over your time investing in just a sec. So also just to kind of cover what Carlos and I are going to be covering in this kind of mini series. So it's going to be everything from kind of what a cap table is and why it's important. We're also going to be showing you how to build your own cap table so that you don't have to be reliant on external lawyers to do it for you. We'll show you how to model out different kind of financing scenarios. So what happens if I raise an equity round, or what happens then if I layer on top a kind of convertible note and raising a safe, whatever it might be. And we'll show you the impact that each of those financing kind of mechanisms will have on your cap table and everything in between, really. So hopefully at the end of it, you'll be able to walk away with a really solid foundational understanding of what cap tables are, why they're important, and hopefully will help kind of smoothen out some of the bumpy ride that the fundraising process is. So today specifically, on this first inaugural episode, we're going to be covering three kind of main things. So number one, we'll be taking it back to the very beginning and starting with the basics. So what is a cap table and what is it not? Number two, we'll be talking about kind of why you as a founder should be able to build your own. And Carlos, I think that's where it's definitely going to be helpful to get some of the insights that you've seen over the years when it comes to the reasons why founders need to know how to do it themselves. And thirdly, we're going to walk through a really, really simple example of a kind of first, let's call it friends and family round. It's the first kind of capital that's coming into your business. And within there are going to be a few key things that we're going to take away. I'm going to run through them very quickly so that we've got them kind of laid out at the beginning of the episode. So number one, we'll be defining certain key terms. So what does fully diluted mean? What is a pre-money valuation? What is post-money? What is price per share, etc. We'll be talking, number two, on the importance of chronology when building out your cap table. So, when things happen matters. Number three, we'll be talking about the importance of share counts. So why we have kind of high share counts versus low share counts. We'll talk you through, number four, some of the visual aspects of actually laying out your cap table. So making sure that there's a distinction between shares and money. And yeah, that's about it for today's episode. So one disclaimer, and Carlos, I think I'm going to leave this to you, but just to explain that this is think of this as a sequel to Legal Hour, which Tom and Carlos put together. So Carlos, I don't know if you want to maybe touch on what Legal Hour is.
Legal Hour, now available in box set format. I love it. At Legal Hour, we spent some really great time, Tom and I, going through all the ins and outs of structuring a deal and what are the things to consider. And so you're right, Felix, this series on cap tables with you hosting it is really how to manifest that into the numbers, how those legal terms manifest into actual fully diluted amounts and all the repercussions. And I think to follow up on what you were asking regarding anecdotes, I use a joke now that's probably a little bit dad joke level, but as they say, no Jedi becomes a Jedi unless they build their own lightsaber. And I would say that no founder is a real founder until they've built their own cap table. And the reason why I say that is only because it prevents you from getting into situations where you don't understand what's going on. And I think one of the dangers of some of the online cap table tools is that they obfuscate some of the mechanics. And then what you can end up very quickly is losing track of where you sit on your capitalization, who you've given what to, how it converts, and all that stuff. So we're starting with the basics, not because this is where people are going to spend most of their time, but it's because you need to start somewhere. So with that, I hand it back to you, Felix.
Cool. Thanks, Carlos. So let's start with the absolute basics. So kind of what even is a cap table? Why is it important? And what is it not? So I think in its most basic form, think about a cap table as a kind of a model or an illustration or an extra, if you will, into the ownership of a business. So who owns what at any given time. And the really neat thing about it, and this is kind of touching to your point, Carlos, about being able to model different situations out when it comes to especially kind of follow-on financing, it enables you to play around and model what different financing situations could look like for you in the business. So to give an example of that, imagine you are in a lucky position as a founder where you've built out your you've got a killer team, you've built out your MVP, and you're going fundraising, and you've got a whole lot of different options on the table. So you've got some investors that are offering you a kind of a price round. You've got other investors that are offering you a convertible note at one valuation or one kind of cap rather. Some want an option pool, some don't, and you're not actually kind of sure how to model this out and what the implications of taking on any of these forms of capital will mean for you down the line. And so that's really what a cap table is helpful for. It helps you model out these different situations and get a really, really clear understanding as to what that position that you'll end up with after those rounds will look like. Just one kind of distinction also to make is that a cap table is different to a share register. And so a share register goes into normally kind of more granular detail of who the shareholders are, but it's something that's required by law. But what they don't do is kind of take any form of, for example, convertible notes or stock options into account. And that the reason for that is because, and we'll get into this, I'm sure in a bit more detail down the line, but stock options and convertible note holders aren't yet shareholders, but the impact of having them on the cap table can be obviously, really, really important down the line when it comes to
and Felix, it's good that you bring that point up, because that is one of the most common problems that I see in pre-seed, where the founders have brought on a lawyer who isn't super well versed in venture law and will represent a cap table where it looks like everything is accounted for, but it doesn't include it because it's like a model based on the share register. And what ends up happening is that there's confusion about, but I had promised this person this and I had promised that person that. And so I think what we want to focus on this example and over the course of the series is thinking about things in a fully diluted fashion. So I'm just going to define fully diluted. Fully diluted for the purposes of a cap table modeling is inclusive of everything, even if it's not been legally executed. So for example, if I promise somebody 2% of the company verbally, yes, of course, technically the technicalities of it being issued have not been yet done. But the fact is that because I made that promise, I should model it so that when I'm asking new investors to invest money, they can see that there is a form of promise that when it gets executed will equal 2% for that potential employee. So I think it's dangerous if you exclude it and then you say, hey, look, we've only diluted, nothing. And then the reality is you've given away half the company to these verbal agreements that aren't manifested on the cap table. So very good point.
Absolutely. Thanks for that, Carlos. Because and I think, you mentioned obviously like employee stock options being one of the potential kind of like failure points there. I think the other one is convertible note holders, in the sense that, if you invest on a convertible note, you're not a shareholder until you actually convert. And so if you're not kind of modeling for that, you'll just land yourself up in an extremely sticky situation down the line. So yeah, so no, thanks. Thanks for
But convertible notes, stay tuned. That's like episode 3? Is that it, Felix? So stay tuned. If you're enjoying this, you'll even love it more in 3 episodes. All right. So where do we take us next, Felix? Where do we go next?
Cool. So I think one thing potentially, Carlos, and it will be helpful for you to walk through if you have an anecdote of a situation in which a founder has been kind of raising capital, and maybe it's kind of, it's not necessarily their pre-seed or their first round of funding, and maybe it's even down the line. Have you, what are the kind of implications of a founder not fully understanding, what a cap table is, and they haven't modeled it out themselves? How sticky a situation can you land yourself up in?
Well, I mean, I think the worst example, and it's obviously tricky without naming names or anything, but I think that the worst situation has been where there's been a series of rounds that have happened. And I think that we'll get into this in a little later, but where the founder has lost track of all the outstanding convertibles, ASAs, and is trying to raise a round, but is requiring like a honest amount of hard work to try to map out something that should have been relatively straightforward to keep up to date. And so that's probably the worst example, to the point where lawyers are getting involved, trying to make sense of all the outstanding interest and all these other elements that come in with convertibles, ASAs, and safes. Mm-hmm. So anyway, I think maybe moving away from that and back to this particular moment in time, which is super early, what we wanted to do in this episode, and of course we'll get to that complex stuff later. This episode's very simple. It's very quick. What Felix and I decided to do is give you an example of a friends and family round. Very simple, very early days, just to showcase some of the key points that we wanted to make in terms of good practices. So those, as Felix mentioned, those good practices involve the share counts, involves the chronology, the layout. So just to make a quick couple of comments here, you'll see that it's a very small team, 3 co-founders and an option pool. We are not making any recommendations here on share counts or in terms of what a founder should get or what another founder should get. So ignore like the fact that one co-founder has this or another. This is just for example purposes. And hopefully what you'll get at the end of this episode is just some visibility on what the impact of taking external money will do to not only the co-founders, but also to any shares that you're promising employees. So with that, Felix, let's go into share counts.
Perfect.
Or definitions. What would you rather do?
I think let's start off with the kind of incorporation. So as you've been speaking, I've just been kind of allocating shares between the founders. So imagine, you're incorporating your company, you are allocating shares between the 3 of you here in this case, and we are going to provision a very small option pool to get put in as part of this kind of, let's make it 20,000. So we've got a 2% option pool before the round, and that's kind of what we're going into this friends and family round with. So to your point, Carlos, on the kind of chronology, so before we even get into this, so one thing to keep in mind, and this is something that we always kind of encourage our founders to think about when it comes to laying out their cap tables, the chronology of it is super important. So think about this. So this is the kind of incorporation stage. This is the friends and family round. Let's say there's then going to be a seed round. This could be a convertible note. Everything flows from left to right. And it might seem really simple now when there's just kind of the most basic form of a cap table here. So it's not very confusing. But once you start layering on different, convertible notes, employee option pool expansions, other rounds, it can get very confusing very quickly. So point 1, chronology is really important. Everything flows from left to right. The second thing, and again, this is also a stylistic point that we encourage founders to think about, is think about your cap table. Imagine you were to draw a line here and you had to cut it in half. We recommend that everything above this line is kind of share related. So here, everything we're dealing with above the line is kind of shares, percentages, and everything below the line. So here it's blank, but we'll fill these things in very quickly. But this is all kind of money related. So 2 kind of key points to start off with to always have at the back of your mind. So money at the bottom, shares at the top, and everything flows from left to right. The reason why I think it's super important, just to reiterate what you said, Felix, when you start having convertible notes are promised for a future event, but
they do, in some cases, accrue interest. In other cases, they have other mechanisms which are time bound. So by having this chronological ledger, if you will, you can set a timestamp that happens when the convertible is accepted and when there's a conversion event in a future round. And by having this chronology, you can work your way backwards and be like, oh, okay, this is how much time's passed. This is how much this has happened. And of course, a lot of instruments today don't have interest, but you still need the chronology because you still need to know, for example, in some cases, there might be 2 or 3 outstanding documents, each with different levels of preference. So you still need to know which one comes first and which one doesn't. So that's the first point. The second point that you made regarding the division of shares and money, it's a very simple one. I see a lot of lawyers do this, unfortunately. They put something like total shares and money contributed. They're both numbers. When you're tired and you're overslept and you're trying to make sense of it, easy to make mistakes, super easy to make mistakes and accidentally misconstrue the number which is on the right, which might be like pounds, to the left one, which might be shares, and you make a mistake, which then you have to revisit everything. So in order for you to have a mental marker, anything above shares, anything below is money.
Yeah. And on this point of kind of shares, and whilst we're still on step 1 in the kind of incorporation phase, you'll notice that these numbers here are quite high. And this number here, a million shares, is also obviously pretty high. And there's a reason that we've done that we've chosen that specifically. So if you have to think about it the other way around, where let's say instead of having a million share company, we had a 10 share company, you're going to land yourself up in a very tricky situation very quickly. And to think about that, think of an option pool where you are setting up 10 or 20 or 15% or whatever it might be, and that would equate to 1 or 2 shares. Those 1 or 2 shares are going to be used for incentivizing a number of employees to come on board. And so very quickly you're going to land yourself up in a situation where you are handing out fractional shares, and that's just that just is going to complicate your life. So
actually, you can't just give somebody a fractional share. So it's not even complicated. It's that you can't. But like if I've seen some cap tables, Felix, to this point where like the lawyer recommended like 10,000 shares.
Yeah.
Like you're giving away a big chunk of the company every time you give 1 share, since you can't do fractionals. Yeah. So hence why having more shares gives you more granularity.
Yeah, exactly. Cool. So that's kind of incorporation phase done. So just to very quickly recap that. So everything flows from left to right, money at the bottom, shares at the top, and importantly, make sure that your share count is high. Then step 2. So now we're going out fundraising. We've got the founders rather, they have they've got a product and they are raising their first kind of round of money to bring their MVP to market, or whatever it might be. And they are raising from their friends and family. So I've just put it here so that we can refer to it. It's going to be £150,000 round at a fully diluted pre-money valuation of £1.5 million. So just to kind of model this out, we're going to actually type this all up. So this £150,000, let's assume that there are 3 investors coming on board. So it's going to be one that's putting in £100,000, and then the other 2 are going to be putting in £25,000 each.
By the way, guys, if you are watching this and you're wondering if these numbers match to reality or what the valuation is, there's a blog post on valuation. You can read it. 2, we've used simple numbers for this exercise, so don't read into it too much. And we use 150 because it's the maximum for tax relief SEIS here in the UK. So it's a nice even number for friends and family.
Exactly. So on this kind of pre-money valuation, so Carlos, you've already spoken about kind of what fully diluted means. The pre-money valuation here is £1.5 million. Just want to make sure I've got the right number of zeros. And so just to kind of recap very quickly what pre-money valuation is and what post-money valuation is. So the pre-money valuation of a company is essentially the valuation of a company, as the term suggests, pre the money coming in. So what the valuation of the company is as you're going into the investment round. And then after the investment, if it's a cash investment has been made, the valuation is going to be a little bit different. And the difference is the size of the round. So here you can see that the post-money valuation is just calculated by adding up the pre-money valuation with the size of the round. So you get a post-money valuation of £1.65 million. Then the next step is to calculate what the price per share is. And that's the price per share that the investors are essentially buying it in at the company ad. So the way to calculate price per share is just the pre-money of the round divided by, and sorry, I should be rounding this. So the pre-money of the round divided by the total number of shares pre the round, right? And you round it down to 0.
I'll add 1 point, Felix, on the rounding. If you go to round and you type in (4), could you do that for me, please? (4), perfect. Do that. Now hit return. So I just want to touch a little bit on this. There is no limitation to some extent on the price per share being fractional. I think there's two separate rounding concerns that we need to cover. One of them is, as I mentioned, there's no fractional shares. So you want to make sure everything that is on the top with share-wise is rounded to integers, because you're not going to have fractional shares. But anything that is in terms of price per share or dollar amounts, you can have sometimes, I mean, I've seen it in little documents up to 4 decimals. So, whether that's practical or not, you can talk to your lawyer, but I've seen it up to 4 decimals.
Cool. So now that we've got the kind of price per share worked out, the next step is essentially just working out the number of shares that each investor is going to get based on that price per share. So the way to do that is you just equal, again, you're going to be rounding down. So you're going to put this investor's amount over the price per share, and you round it down to nearest 0. Close that. You're going to have to do this kind of 3 times. So 25 divided by that. And
while you're doing that, I'm just going to explain why the rounding down, because it's super simple. You're not going to give people more shares by rounding up than their money. So, of the 2 options, it's the less nefarious one, rounding down to an integer value.
Yeah, exactly. And so now you can see, I mean, we've essentially modeled out the whole kind of round happening, and you can see the dilution that every existing stakeholder here has taken on. So Vanessa was at 40, she's now at 36.35, etc. And one of the things that you'll notice here is that the option pool was 2%, it's now at 1.2%, 1.82% rather. And we're going to be talking in the next episodes as to kind of what that number is, what that number should look like.
This concludes the key components of this particular episode, but I just wanted to add some final parting thoughts. First of all, stay tuned for the next episode where we'll cover the expansion of this option round and a seed round by an investor coming in with institutional capital. But if you look at the impact of this round, this friends and family round, you'll see that it's proportional across the entire founding base, including the option pool. Let's say, for example, that this 2% from the option pool in the interim between when you started the company and when you raised this friends and family, it was given to somebody as an employee. You will see that employee went from 2% to 1.82. And this is why it's important when you talk to hires to tell them what the number of shares they're getting. Because if you had accidentally told them that you were going to do a 2% option grant at the end of a round, they would have been upset at you because they ended up with 1.82, or you would have had to dilute further to make up for that gap. So when you're talking to potential new hires, I think it's important to make sure that you talk about what it represents at the moment, especially if you're doing that prior to a round, and that the impact that the new round will have on their shareholdership. So with that, what you can see here is we've completed the first phase of building a cap table, which is just building the foundation for the next episodes. And as Felix mentioned, the next episode will be option pool expansion, a simple equity round. Then we'll move into the more complex stuff. And then we'll end with the pièce de résistance, a fully fledged, multi-round, multi-instrument cap table. So thank you, Felix, for hosting us.
Thanks,
and guys. We look forward to hosting you on our next episode. See you later.
Cheers.